taking over of the. Okay. Good evening, everybody. August 22, 2021. We're gonna talk about a super exciting topic that I always love, and it's futures. And we're gonna focus futures. There's a lot of futures. You know, we can trade the corn, cotton, a lot of commodities, but we're not gonna mess with that issue right now. We're just gonna get involved in futures for S&Ps because it's a good tool for us to either hedge or go aggressive against ups and downs on the market. And for a lot of you that don't have a 25K or more account, the beauty about this is that you don't get in intraday pattern rules and stuff like that. So that is what is a very nice way to hedge that probably you didn't know that existed, but it has some perks that you have to understand first. And for that, I'm going to share my screen in the most important part, which is the option chain, right? So what is, to begin with, options, futures, or futures in general? They are regulated by a different entity based in Chicago, that most of you, or probably some of you, are aware of. That is the CME, that you can log in and look for it. This is the Chicago Mercantile Exchange that it was established almost 100 years ago, where everybody started to trade futures for different type of commodities or products, right? And at the end of the day, what futures are is if you just, it's like an insurance. If you would like to secure a certain price in the future, you just buy it right now, and if it goes more than that price in the future, you're a winner. And if it goes less, you're a loser, or otherwise, right? So, but at least you have a security that certain products, you're gonna be able to buy it at the end of expiration at that price. In our case, we're not gonna do that. We're just gonna take advantage of what the future offers, and that is what I'm not gonna focus on many different type of futures, because there are so many, and each and every future type have a different structure in terms of what the time of trading. Soybeans and corn futures don't have the same trading hours than cotton, than oil, than S&Ps. And each future has a specific characteristics in terms of margin requirements and things like that. So, of course, you're free to jump in the CME group site that you can find the site very easily in Google. But specifically here, we're gonna focus in the S&Ps. And in other words, we're gonna work on the futures on the SPICE, SPX, and more or less is what that means. So one thing that you have to take in consideration about futures in terms of we're gonna go directly to the S&Ps. You have futures on the S&Ps, and you also have the opportunity, as well as most of the futures, to have the opportunity to trade options on those futures. So it's like an underline, like Amazon, that you have the stock, you can buy the stock, and you can also trade the the options, same as the futures. You can buy a S&P future, which is the ES or the E-mini that is called, or you can trade the contract for options on that E-mini. And what is so exciting about it is that what people like to buy or trade futures because you have more leverage on futures. Buying, for example, I'm gonna give you, to begin with, it's very simple. What is the pros of having the ability of play futures? To begin with, you need a margin account. And besides having a margin account, you have to open a future account that sometimes is gonna be on the same account, but it's handled differently. Even though in most of your accounts like TOS and E-Trade, Tastywork is gonna appear within your margin account, always futures are managed in a different account. So the settlement is different, but you're gonna see it more or less in the same account, but you're gonna be able to trade those. I just want to make sure one thing. I want to see that I'm watching to the. Okay, yeah, I'm watching to the chat here in Zoom. That's what I interrupt myself a little bit. So I just want to make sure that you can see what we're watching right now is the option chain, right? Somebody just give me a thumbs up that we're watching the option chain so I can start explaining a little bit about where we're gonna go after this. Anyone? Or jump in on mic and say, yes, we're watching the option chain.
We lost the screen share, Alfonso.
Really?
Now I can't see anything.
Okay, so that's what I ask. So you have it now?
Yep, we can see it.
Yeah, I can see it now.
Now, jump in, guys. Don't let me talking about myself because I'm very stupid on this application. So options, buying a E-mini. Let's start with the E-mini or the S&P futures. What you need, the only reason that is very complicated to be involved in it is that if you go to futures here in the TOS application and you look for the ES, you have to look for the margin requirements. In other words, is how much you have to have as a backup on your account in order to be able to buy one S&P futures. And if you see it here, is $17,000 and $300. So 17,300. What that means? That if I want to buy one S&P future, I need to have at least available in my margin account almost $17,300. And why is that? Because obviously, once you get into this contract and you buy it, these contracts move differently as not move differently, but it's quoted differently as a stock. The futures are how do you can I tell you are recorded by ticks. So each point of the S&Ps, I'm talking about a product that is right now 4,446.25. Each point has 4 ticks. So you're never gonna see the S&Ps. That's what they move between 25, or it's 25, 50, 75, 00, right? and each tick it's worth $12.50. What that means that for every point, if you buy an S&P future, for every point that the S&P goes up or down, you lose or win $50. As simple as that. And what is the beauty about it? What people, because one S&P contract of futures is the equivalent of 500 shares of the SPICE. So in other words, if you want to buy 500 shares of the SPICE, and we can do the math, somebody can help me out, 500 shares of SPICE times $444, you tell me how much you need to buy that, right? Anyone? Anyone? Let's make it some kind of interactive here. And you can chat on the Discord if it's better for you, because actually let me see the chat here, participants chat. Anyone? How much is 500 SPICE shares? I don't see anyone participating. Don't get me go to my. Okay, if nobody wants to participate, I can tell you that. 500 times 444 is $222,000. So the beauty of futures is precisely what I was telling you about, the amount of leverage that you can make, right? So with one S&P future, you can be holding the equivalent of 500 SPY shares, that if you want to buy those shares, you will need $222,000 instead of the 16,000 that is the margin required. So everybody's following on that? Are we okay on that? Anyone? Okay. Yeah. So that is what is so attractive, right? The problem with this, the S&P futures, is that that margin requirement, it's updated every day accordingly to the price to the S&Ps. So if you lose or win whatever amount on that position, the next day you have to have that as a backup of margin requirement, and it can be more or less, regardless if you made or lost money on that contract. And that is what is for example, in a lot of people loves to trade the Nasdaq. The Nasdaq is also very interesting. Why? Because the Nasdaq is only instead of $12.50 per tick, it's $20 per point, so each like $5. But the problem is that the Nasdaq moves like 10 times. If the S&Ps move 1 point, the Nasdaq move 10. So it's more volatile than the S&Ps. And that's why some or many people like and even do a living trading the Nasdaq or the NQ futures, because in a matter of 20, 30 handles, and a handle is a point, is that how they call it, you can make a living. every day. But on the other part, it's very complicated. Usually, when you trade futures in the S&Ps, you for very important, you have to use a tool like the active trader when you can have rackets. I mean, it's a suicide in trading futures if you just buy one long or short and you don't have a stop and a limit order on the upside. So that is super requirement to have that. But in our case, we're not talking about the future itself. Now we're gonna jump to two more instruments that are gonna be very helpful for us, which are the options on S&P futures. And the options on S&P futures are even more interesting in the way that you can trade in some way the S&P futures without leverage, but with limited risk, right? Because as options, we all know it, they work the same. Whatever you put inside, if you are buying an option, your maximum risk is whatever you pay for the option. Before going to options, there's another product that was launched less than a year ago or a year and a half. I don't even know, with this pandemic, I don't have, no, probably it's 2 years ago already, which is the micro, not the mini, the micro futures, which is the same, but the only difference is you just put an M here. And it's the same product, but the difference is that is 1/10. So everything that I explained to you is the same, but 1/10 of it. And this is the product that is very interesting. So instead of buying 500 SPY shares, this is the equivalent of having 50, right? A tenth. And this product was developed exactly for that, in order to give more the ability to trade futures for people like us that have a different size of port, if you would like. So if you see it here and you go to the requirements for this product, in terms of margin, you can look at here. Where is it? MAS. It has to be, here it is. You only need, and that's what this is the product that I suggest you start. You only need $1,200, $1,265 off balance minimum to buy one contract for the micro futures. Okay, so it's the same as the S&P. The mini are the minis and the micros. Why are they called the minis? Because the actual future is 10 times higher. So nobody trades that. That's a different story. But the minis, we already spoke about. The micro is 1/10. And for both the minis and the micro, you have options for those. So now let's jump on the options. And I'm going to start with the options on futures. That to begin with, what do you need to trade this animal? You need to open a margin account. Second, you need to open a future account that is going to be within your margin account. And the things that you have to take care, and the downfall on this are that the commissions are a little bit different, because besides the normal rate that they charge you for other type of options, since this is not regulated by the same entity, and you don't get an intraday pattern and that type of shit, you have like a 50 cents per contract extra charge on fees, because you don't ask me why, but that's what they ask, you know. So if you want to buy this one, for example, and that's what I like TOS, TOS is very specific. It's gonna be $2 of the option as any other, plus 57 cents of the fees. And the fees are the exchange fee and the NFA fee, which is the entity that regulates the futures in this case. So that is the bad news about it, is that it costs you a little bit more. Give me 1 second, because my dog is barking like hell that needs to get in. Yeah, he's getting. So we already know that, okay, it's about the same, about commissions, but the difference, and if you don't have TOS and you have other broker, they're not gonna tell you about those fees, they just gonna charge it. And that's what TOS is very transparent in that regard. So it's good to know. But first of all, okay, so this is complicated, guys. Futures, you can trade futures for so many products. I'm not gonna get in any of them, only the S&Ps, because each future product has different margin requirements, different times for trading. Not all futures trade the same trading hours. They have different settlement. Some of them are American and European settlement that if you look in Google, you can find the difference between one and the other. I don't gonna get in that right now, but so many different things. But at the end of the day, what we need is this, because sometimes, how many times we're playing intraday and we will, Alfonso, so you need a margin account? Yes, you need a margin account to trade futures, definitely. There's no other way to do it. Okay, yes. So sometimes that I tell you, buy spice puts, because the market is gonna. So instead of doing that, what I just do, I just put a future, right? And what is the nice thing about the future? And I'm not talking about the future option. I'm talking just a future. A future doesn't have decay, doesn't have expiration. You just have to take care of it. That doesn't move more than you're willing to lose. On the other hand, if you want to go to futures, which I recommend you to do it first, and don't do it on the ES, do it on the micros, which is 1/10. So you even have you can even trade the micro futures directly, because instead of losing $12.50 for each tick, you're gonna lose $1.25. So, and you only need $12,000, $1,200 in margin. It's a good way to have a sense, but you already know that having a micro future, a E-mini is equivalent of 500 shares of a SPICE. A micro is equivalent of 50. So you already know how much in terms of deltas. This is a little bit more complex, but it's a way to say, okay, I don't know how many deltas negative, and I have to compensate my risk. You already know how many SPY deltas each product has, right? But I'm not gonna get into that because I know that I'm gonna confuse a lot of folks here, but you can find that. But coming back again, okay, now that I gave probably a very cheaty and stupid information about how future works, I'm gonna get to how the S&P options on futures works, which is a different story as well. So if we go to the chain, the way to find the S&P future is the same, dash ES. I have here the futures. This is the active. So if I want to buy a future here, I just go directly to the S&P, and that is where I, for example, if I try to buy this one, it's gonna ask me to, I'm gonna need 12,650, right? And that's what I explained to you early. That's the margin requirement. But on the other hand, in futures are the same. I mean, it's, you have a chain, which is a little bit different because the most important part that you have to take in consideration is the days to expiration. Because in any time here, you're gonna change from one to another, but another expiration in the futures, but not in the options. But anyway, the most important part is that you look always what is the expiration date. And it's gonna tell you in TOS, it's gonna tell you here how many days you have to expiration. What is the advantage of futures? That you can, first, you don't have intraday pattern. You can buy them and sell them as many times as you can in the day. Second, you can trade this instrument overnight. What I mean overnight, for example, today, Sunday, 5 o'clock Central Time, you can start trading them. They are up and running. So it's a good tool. So if you see that the market is tanking and you have a lot of long positions, you can buy even a future, or you can be long or buy a call on future options in the middle of the night. What you cannot do with futures is the day that you cannot buy future options 15 minutes before the close. You can sell it, but you cannot buy more. Why? Because they settle at the close and they open 15 minutes after that. So it's a little bit different, but practically you have future options or in future working for you most of the, not of the day, but most of the trading hours, right? Are we okay, right? Because I'm just speaking. Okay. The difference. Any questions here? I need to hear a little bit from you first, because the next part is what I'm going to explain you how to buy a S&P future option, which is a little bit different than the rest. Any questions? If no, at least anybody say no. Okay, a lot of good information. So there are expirations on the option contracts, but not expirations on the no, it's the same. The MES is the same as the ES. The only difference that the micros are 1/10, and both have the same. The only difference, they have the same rules. The only difference that the MES is 1/10 the value of the ES, but everything is the same. MES, it was a way to give access to many retail traders like us to trade futures, as well as MES, the micro S&Ps. It came the micro Nasdaq, the micro Russell, and we had micros like 8 or 7 products they launched. What they just did is just reduce the cost of it, and they divided by 10 so everybody could have access. The only thing that is not very fair about the micros is that the commissions are more or less the same for both. So you are talking about commissions on a product that is 1/10 the size of another one, and more or less it's the same commission. So it's a little bit more punishing in that regards. But the expirations and everything, the way they work, the settlement times, the trading hours, everything. So it's the same. The micros, it's just like the name, are the mini-me. The mini-me. Probably is. And when you buy options, always, when you buy options, always, the risk is only what you pay. If you sell an option, it's the same risk. I mean, that's a different story, right? You have a different risk. But if you're buying options on futures, it's the same as buying options on any other underlying. Your risk is limited to the cost of your premium. That's it. So that is the beauty about it. Not that you're gonna make more or much. And the other thing is that you have less than 25K, you can be trading intraday all day, that shit, buying and selling, and you, besides the commissions that are gonna eat you probably, you're not gonna get in trouble with intraday pattern trading, because it's ruled by a different entity. But it's not, it's a good way. For example, if you're gonna, instead of buying spice, just buy the micro directly, the future, or an option on it. And you know, if you buy a micro, for every point up and down, you know that what is your risk, right? Anybody can tell me on a micro? What is the risk on a micro for up and down $1 on the S&Ps? I want to know if somebody understood this. On a micro, not on the mini. Anyone? I want answers.
Probably $1.25 per tick.
Times 4, yes. $1.25 times 4, yeah. That is correct. That is the risk of buying a micro. If you buy a mini, it's $12.50 per tick, times 4, $50, right? In the micros, it's $5. So if